Like basically there's an equivalent of a massive recession in the Bitcoin price every 18 months over the last decade, which is kind of crazy. The price discovery of technology company assets in the private markets is so massively asymmetrically favoring a super, super tiny group of people. We have never seen a single public technology company enter the public markets in the last 10 years, maybe even the last 15 years, that has delivered venture capital-like returns for retail.
Satoshi is arguably the greatest entrepreneur of all time. I mean, he created $1.7 or $1.8 trillion in value in 15 years, whatever Bitcoin's worth right now.
Bitcoin is digital capital, right? Beautiful way of describing Bitcoin. Bittensor is digital capitalism. Bitcoin is a bounty on chip design improvement to solve SHA-256. Bittensor is a bounty on any technology improvement.
Well, JJ, what are you grateful for this Thanksgiving in terms of Bittensor and TAO?
I am grateful for the incredible conviction of TAO holders. And I think it's pretty evident. I mean, there's been a massive correction, obviously with Bitcoin dropping, I think 30% over the last month. And I think we're down seven or so percent for the year. But I mean, Bittensor's been holding pretty strong. I think if you take out the meme coins, we're in the top 20, which is amazing.
Yeah, and if you take out the stable coins and meme coins, I believe we're in the top 20. Yeah.
Yeah, I mean, maybe even top 15. But yeah, it's pretty incredible.
I would say during this past month, which has had this crazy action. I mean, a couple of things to point out. One is Bitcoin is at its most extreme fear, and I don't know how they measure that, to be fair, but since on every metric since 2022, which is ridiculous. In 2022, we had an anti-crypto president, an anti-crypto SEC, an anti-crypto CFTC, an anti-crypto banking system. 2 countries in the world, El Salvador and Central African Republic, were the only ones that looked favorably on Bitcoin, and now there's about 30 countries that are accepting Bitcoin in their strategic reserves. There were no Bitcoin ETFs, and this is just Bitcoin. But as you pointed out, a lot of the price action is correlated right now to Bitcoin. Now, when Bitcoin goes up to all-time highs, I will notice during this period, TAO decoupled for a little while, went from 380 to 536 in one evening. And then, of course, it got the memo that it was supposed to go down with every other crypto, but now it's down since then. But it showed that it could move very quickly when it's unleashed. And actually, do you know why it went up to 530? Like, I'm still trying to figure out. It went on $1 billion in volume. Like, who's buying $1 billion worth of TAO right now?
Well, I think it's always kind of unpredictable when people will come in size. I think a lot of bigger institutions have taken time to develop their own internal points of view and like a thesis about, should we get 10 million of exposure, 50 million of exposure, 100 million of exposure. I won't name them, but actually one of my investors, I would have to say they're a top 10 venture capital fund. I won't say more than that. They were like, how do we get, 20, 30 million of TAO exposure? We've been following along. We listen to the podcast. We see your tweets. We see your investor updates. And I'm like, I'll just give you all the details. And I gave them like an hour of my time, kind of just giving them all the different dimensions of everything, how I found about it, how my conviction developed over the last 3 years, which has really been a journey. And I told them, to your point on the volume, James, like the markets are so liquid now. Between Binance and Coinbase, you could get 10 or 20 million of exposure and DCA in 3-4 million a day without tickling the price. Like the price wouldn't remotely move, because even if the volume comes down by a third or half, there's still 200-300 million of daily volume. And so, we're talking about 1% slippage. So you can get very meaningful TAO exposure if you have a fund that's like a 10 or $20 billion fund across different vehicles, and you're like, JJ's excited about this it's very asymmetric. There's a bunch of other people talking about it. Maybe we should have 10 million or 20 million of exposure. If enough funds do that, I think you could see these kind of like intermittent periods where volume spikes and goes up a lot, because they could be plowing in, within a very short time frame. Maybe they don't really want to do a DCA. But I think a lot of funds are sort of thinking about how to do that.
Yeah, and I would just say from our approach, and I'm not saying anything not disclosed, like you could just see from our public company releases, we basically average in every single day. And, you could see over time, we've issued 2 or 3 different press releases about our holdings, and they've grown substantially over time. So
yeah. I mean, one thing I saw 100%. No, dollar cost averaging is the smart and risk adjusted way of accumulating an asset that you have very high long-term conviction in, especially one that's a liquid asset. It's harder to do that in the private markets, obviously, because things are so infrequently accessible in terms of assets moving and buying and selling and stuff. But public or traded assets almost always want a DCA. And I saw a post from, I think it was Anthony Pompliano, about the last 10 years, we've seen, I think, over a dozen 30 or 40% drawdowns. And he made the comparison to massive recessions. Like basically there's an equivalent of a massive recession in the Bitcoin price every 18 months over the last decade, which is kind of crazy. It highlights the level of volatility that the asset has consistently demonstrated, while also demonstrating the highest outperformance and asymmetry relative to literally any other asset in existence.
Yeah, I mean, look, you're never going to see, it's rare that you're going to see Exxon draw down by 30 or 40%, Exxon stock. But that's because it's also not going to go up 1,000%, which Bitcoin is known to do. I mean, after Bitcoin's first halving back in whenever that was, 2013, it went up 2012 went up 7,000% over the next year and over the next 18 months. And so I don't know if TAO is going to do the same thing, but I mean, there's a lot of anticipation about this halving. We'll see if it's, and we've talked about this before. I really think the biggest catalyst by far for TAO and Bittensor is going to be the success of the subnets, showing the world that, hey, not only does this ecosystem create these amazingly valuable companies, but I could buy a piece of that ecosystem. I can't buy a piece of Y Combinator. I can't buy which Airbnb spun out of, Dropbox spun out, many huge trillion-dollar companies spun out of Y Combinator. I can't buy a piece of Peter Thiel's fund. I can't buy a piece of Andreessen Horowitz. Oh, but this TAO, not only could I buy a piece of the TAO, but I could buy all these startups at like $8 million market caps before they go on to be multi-billion-dollar market caps. This is totally open to the retail investor. And as you pointed out before, the subnet's being built on top of TAO. It's like a mini S&P 500.
It's a stock market. It's a stock market.
It's a stock market, though, of startups, which is amazing.
Yes. It's the transformation of capitalism into full, liquid, real-time, priced from zero, fairly available, permissionless assets from the very beginning. There's no insiders. There's no venture capital getting their take. I was interacting with someone on Twitter. I won't mention who because it's pretty recent and you'll be able to pinpoint it. But fairly well-known venture capitalist that I have a huge amount of respect for. I'll actually just say who it is. It's Brad Gerstner from Altimeter Capital, who I have a lot of respect for. And Brad was commenting on the Figma drawdown, the Figma stock, because they went public, I think, like a year ago or something. And if you recall, Adobe tried to buy Figma for, I think, about $25 billion a couple of years ago. And the regulators blocked it because they thought it was like an antitrust thing. And they thought that, Adobe was going to have this like photo design editing software monopoly or something. So they blocked it, right?
So
which is
insane.
Totally retarded because Photoshop is a totally different product from Figma. And it's like a consumer versus a professional user base. And it's like the whole thing was stupid. So, but the lockup or the breakup fee, I think, was $1 billion. So Figma ends up with $1 billion in cash on their balance sheet for basically getting screwed over by regulators. And then they go public, right? And the public stock priced it at, I think, about 40 billion, 35 or 40 billion. And, they went public like, I don't know, a year ago or something. I can't remember. And huge drawdown. huge drawdown. And so I think it's trading at like 15 or 17 billion or something now, right? And the business has continued to perform. It's a fast growing business, great company run by a very talented entrepreneur, Dylan Field. And Brad was responding to someone saying like, look, this is just crazy. Like retail, they have the first opportunity to buy this stock, Figma's going out. It's an exciting tech IPO, and they just get screwed. They get hosed by, the investment bankers mispricing, right? The mispricing of the IPO allocation to, the people who buy into the IPO, the people who have the lockup periods, they sell, their lockups, and VCs own 30, 40, 50% of the company. They have to distribute, those shares to their LPs. The LPs sell down. And so there's basically this like kind of precipitous drawdown in sort of the transformation of the shareholder base from private shareholders to public shareholders, institutions, and retail, right? And so this happens with every company that goes from being private to going to being public. And it just dawned on me, Brad's response was like, well, what do you mean? That's actually a great price for Figma, 17 billion. I'm looking at the revenue multiple, pretty good. And the reality is, not commenting on anything that Brad does with his company and his business, which is a phenomenal firm, but the venture capital sort of like Silicon Valley asset class prices companies to as close to perfection as you can possibly imagine. In fact, much more generously, right? And so the revenue multiples, as Figma was raising seed, Series A, Series B, Series D, and so on before going public, were vastly higher revenue multiples than the public markets are giving the Figma stock today, right? So like if you look at the Figma stock revenue multiples today, it's like a 15x or 20x or something like that on the revenue multiple side, which I think is actually accurate. You look at the private venture capital pricing revenue multiples when Figma had 50 million of revenue, 100 million of revenue, 200 million, right before they're public, right? Those revenue multiples were super, super high, 50x, 100x, 200x, right? And this is just a very common story, okay? Not to pick on Figma or that exchange, but the reality is, and this is what I was commenting on to Brad, which is really kind of like representing our entire conversation over 12 episodes now. We've been doing this for 12 episodes, so congratulations, James. Happy Thanksgiving. Happy Thanksgiving
Same
week.
to you.
Thank you, sir. The price discovery of technology company assets in the private markets is so massively asymmetrically favoring a tiny group of people, a super, super tiny group of people. By the way, I am one of them. Okay. Now, I'm not in the Silicon Valley, group of multi-stage funds that price things from seed, Series A, B, C, and D, like funds that have 5, 10 billion under management. But I do lead seed rounds and Series A's. So I do participate in this ecosystem. But it is very unfair to retail and mainstream people that when a great technology company goes public, and what I was mentioning to Brad is factual and is really me commenting to the entire venture capital ecosystem. We have never seen a single public technology company enter the public markets in the last 10 years, maybe even the last 15 years, that has delivered venture capital-like returns for retail. It has never happened. Not one example, and I fact-checked myself because I don't like making assertions that end up being fact-checked by people and proven wrong, right? So I did this, and I asked the AI, I did a thorough deep research, one of the ones that takes like 10 minutes to search and stuff. And I also did my own research. The only one that came close was, I think, an ad optimization mobile company where the stock appreciated by 15x in the last decade.
What has Palantir appreciated since it's gone public?
I think Palantir's done close to a 15x or 16x since their IPO, which I think was in 2020. Okay. And you have to adjust that for dilution and stock-based compensation and share issuance, as we know, as we've discussed in the past. And so you have to offset that differential. When you do that, then the multiple is lower. Okay. Cash and cash multiple is lower for entering the stock and buying some number of shares and then holding for the period, which again, most people don't do. You don't hold. It's very rare to see someone say, buy at the IPO and hold for 5 years or something, right? You do all the speculation, you're selling in, you're selling out. People don't have patience. They just don't make value investing type trades on technology stocks that are very volatile. And so there's not a single technology IPO. I just want to emphasize this fact. This is factual. There's not a single technology IPO, not a single one, in the last 15 years, not the last 5 years where we've seen lots of IPOs, but in the last 15 years that have delivered retail traders venture capital-like returns. Now, what I want to unpack there is venture capital-like returns are very measurable and understood, okay? Venture capital-like returns of 50x or 100x, okay? A venture capital-like return is actually something like maybe a third of what Bitcoin has delivered in the last decade, which is more like 250x. That's insane. That's like a holy shit level return. But a venture capital level return is like a third of that, okay? There's not a single public technology company that has gone public where the appreciation opportunity of entering the asset has given someone venture capital-like returns. Now, again, to summarize, what are venture capital-like returns? For venture capitalists to have an opportunity to return multiples of their funds, which is what they're measured on, at the deal level, at the investment level, at the individual investment level, they need to see 500x to 1,000x returns on their investment. On the low end, 100x. On the low end, 100x. Why is that?
By the way, not on every investment, just on their winners.
On the ones that actually make money. And I want people to understand this, and this is actually very common knowledge. There's this thing called the Pareto distribution. By the way, this governs all complex competitive systems known to man in science, but in particular, it governs portfolio construction and investing and allocating capital and generating returns.
And employee value and the number of flowers that bloom in your garden compared to the number of seeds planted. Like, it's amazing how much this works.
It's incredible how general this principle is, the Pareto distribution. It's also called the power law distribution. And essentially the way it works is about 10% of the distribution is responsible for generating 90% of the results or the outputs. By the way, there's more extreme Pareto distributions where you could say less than 5% of the distribution or of the data is responsible for generating 95% of the results. In many cases, it's 80-20, right? But it basically says a very small fraction of your basket will result in the results, produce the results of whatever you're measuring in the entire basket. Okay, so venture capital funds also get affected by this fundamental math, which is, and you don't know which one a priority, right? That's just very hard. But out of, say, 50 investments in a fund or 20 investments in a fund, if it's an early stage fund, call it, I'll give you an example of the absolute best funds in history, which are like, I don't know, let's say Sequoia's funds or Benchmark's funds or, some of these venture capital firms, right? Out of 20 or 30 investments in a $100 million fund, to 10x that fund, right, to generate $1 billion in returns on that fund, there's really only going to be maybe 2 or 3 investments out of the 20 that generate 90% of the $1 billion in returns. Now, you have to understand the cost basis for, say, a $10 million check that generates $1 billion in returns has to be 100x at the deal level. In fact, even higher, because very seldom do funds have that much concentration. Oftentimes, you want to limit your largest investment in a fund to maybe 7% of the fund, or maybe even 5% of the fund if you're really conservative, right? And so it could be even 200x. So at the deal level, that's what we're talking about. At the fund level, we don't really want to talk about that because venture capital is really abysmal, unfortunately. So when you say fund level, there's plenty of stocks. There's plenty of stocks at the fund level that have delivered venture capital fund level returns, but investment level returns do not present themselves in the public markets in the last 15 years. And what we're talking about with Bittensor is something that people really need to understand. When you have this asymmetry of pricing an asset and this price discovery so trapped and so concentrated in the hands of such a few number of entities and institutions or people, but it's largely institutions like, in Silicon Valley or in the venture capital sort of like, I hesitate to call it an asset class. It's not really an asset class. It shouldn't be an asset class because it's so artisanal and so non-generalizable because it's a game of outliers and a game of betting on people that are truly extraordinary and change the world over many generations. And the number of companies that generate the vast majority of the returns in venture capital are so few out of the thousands that get funded. There's so few. And so, it's really just kind of a testament to how incredible Bittensor is to basically say, let's upgrade and change the entire capitalist system and create a fairly priced equilibrium of asset discovery, asset creation, and asset trading from zero, while mitigating the potential for insider manipulation and perverse incentives, and also mitigating the sort of mispricing of IPOs, right? And so Bill Gurley is actually known for evangelizing the direct listing, right? Which basically says there's no sale of shares when you flip the company from being private to public. You just take it public, right? And now the shares are all traded. There's no lockup, right? There's no the investment banks are basically disintermediated. Many companies have done the direct listing to very interesting results. The pricings tend to be more accurate. But again, that doesn't solve the fundamental problem, which is that how did the company get capitalized and funded for the first decade of its existence, 15 years of its existence? By the way, technology companies are staying private longer. Why are they staying private longer? Because the size of venture capital has ballooned so massively, because almost all pools of money are chasing the asymmetric returns of technology companies, right? And so anyways, this is just perpetuating.
No, that's a good point though. That the secondary markets now, like if I'm a founder of a tech company and the tech company is worth $40 billion, I don't want to go public and risk the stock crashing.
Stressed.
So I can go to my VCs. They're more than happy to buy more shares directly from me.
Absolutely.
I'll cash out of $2 billion.
Absolutely.
I promise I'll keep running the company.
Yes.
And then, whatever. But, there's a lot to unpack in what you just said. And this does lead, like you were pointing out, to TAO and Bittensor.
Directly.
I've been, last week, I kind of went on a little rant about how people should be outright outraged about the banking system and banks and central banks and so on, and how they take your hard-earned money and like squeeze every fee out of it and essentially rip you off. And that's kind of the reason Bitcoin was created. And then we talked about Bittensor, but really the other thing that people should be outraged about that they're not really aware of is Wall Street. And like the IPO process, first off, and the venture capitalists, not everyone, but venture capitalists are complicit in this as well. Venture capitalists, their exit is usually when Wall Street begins. So like the venture capitalists exit at the IPO when they can no longer value the company any higher. That's the time, okay, let's just sell it to the naive investor, which is unfortunately the Main Street investor who is buying shares from their stockbroker who doesn't know anything. So Wall Street says, okay, we're going to take your tech company. Oh, the last valuation was 10 billion. Okay, we're going to take it public for 50 billion because that's when we're going to generate the most fees from that. Wall Street takes a percentage of the money they raise. So their incentive is to raise as large amount as possible. But to do that, they have to value you as high as possible. And of course, they have to justify it, but they'll do anything they can to justify it because every dollar more they value you, they get an extra 7 cents. So if they're raising, $1 billion, they get 70 million usually, or 30, between 30 and 70 million. If they're raising 10 billion, they're going to get between 300 and 700 million. It's huge numbers. So their incentive is to pay off the VCs as much as possible and sell to the retail investor as high as possible. There are no returns left for the retail investor. And that's why the VCs are selling then. And look, the VCs are complicit because, let's say I'm in a seed round. I got in a seed round. And the seed round was a $5 million valuation. Now we could raise money at a $100 million valuation. A lot of VCs count that as a return already, and they take fees off of that new valuation. And it's
correct.
It's very unfair, but their investors have no say in it. So there's a lot of things really unfair about Wall Street. I was writing about this 20 years ago in the Financial Times. I remember talking to Bill Hembrecht about this and Bill Gurley about this problem 20 years ago. Hembrecht and Quist, was doing the direct listings. They started the whole direct auction listings. I don't even know if they exist anymore. But I think Chase might have bought them actually. But the banking system, Wall Street, the VC system, not always. There's good intentions too, but it's very complicit in this theft of the hard-earned dollars of the average working person who wants to just keep saving their money and earning more. Whereas, and brings it all back to Bittensor, and I want to bring up a tweet you did earlier today. This all goes back to Bittensor where there's nobody in the middle. Like when I buy tokens of Ridges, say, or Shoots or Targon, that's what they're worth now. Now, we've discussed the relationship between equity and subnet tokens in another podcast, but let's just say for now, that's what they're worth. I mean, you're talking about Ridges that's going head to head against Cursor, worth $30 billion, and Ridges is worth what? $40 million right now? 40 million versus 30 billion. So this is like a fair, I don't even want to say fairly valued, because here's the problem with Bittensor. Nobody even knows about it yet. Now, that's because one of the catalysts that needs to happen is one of the subnets needs to be a huge breakout success. Well, Dynamic TAO, which is where the subnets started really coalescing, only less than a year old. So this, the average VC portfolio is 10 to 15 years now. So subnets, but we're already starting to see subnets on the verge of breakout success. I just mentioned Ridges, but there's also, Shoots, Targon. There's many I can name, maybe even bigger than the Pareto distribution would allow for. But once these subnets achieve breakout success, even just one of them, people are going to say, oh, wait a second, I could have bought that at a $10 million market cap, which a few weeks ago you probably could have bought Ridges at a $10 million market, or a few months ago you could have bought it at a $5 million market cap. I could have bought that at a tiny market cap. I could have easily gotten my subnet tokens. I didn't need any permission from any VC. I get it at the market valuation, and I'm competing against. I'm potentially going to see this go from $10 million market cap to 30 billion. Oh, and then in order to buy a subnet token, guess what? You have to first buy a TAO token. So once you are aware that subnets exist, that's when the real buying of TAO has not even occurred yet. It's not even begun. People don't know subnets exist.
Hasn't even started. I totally agree with you. The price discovery of Bittensor to date has been dominated by, I would guess, some group of a couple hundred people that are really big believers, largely previously wealthy from accumulating Bitcoin or Ethereum, from mining activity or from buying very early and rotating those trades, or potentially people who are not into crypto previously and just expressing significant conviction and buying in, like my fund or others. And, there's probably been something like on the order of, $3 billion or so dollars, dollars worth of value transformed into TAO over the last couple of years, or 3 years, let's say. And this is really tiny, right? I mean, how many seed or Series A rounds for AI startups have you heard in the last 6 months, James, that have raised a couple $1 billion? And it's kind of a long list.
Oh yeah, I mean, look, if you add up all the VC funded companies, including Anthropic, Perplexity, OpenAI, which between them they're almost $1 trillion, and then you add in everything else, and then you say, wait a second, TAO's got 128 companies sitting on top of it, of which TAO to some extent owns their successes. Like if any of those companies are successful, that immediately translates into TAO being worth more, and yet the whole entirety of TAO is worth, or Bittensor is worth $3 billion. It's just ludicrous. What it shows me though is that people just aren't aware of it yet, and the reason is because TAO's not really. Yes, it uses crypto technology, uses blockchain, and it has the same ethos of decentralization, permissionless, trustless, blah, blah, blah. But if you look at all the top 50 crypto tokens, they're all DeFi. This is a currency. This is a DeFi exchange. This is a lender. This is an oracle of some sort. TAO is the only one that's actually, it's about entrepreneurship. It's about building real companies that are going to change the world. It's very different and unusual compared to the other top 50 cryptos. So and because there were no VCs in TAO, just like in Bitcoin, as you pointed out, JJ, so only 2 tokens in the top 100 that are not VC funded. So, but the one downside of that, the upside is that you don't have VCs dumping their tokens once they are unlocked. That's the downside of VC funded. But there is an upside of VC funded, which is that VCs get marketing, VCs get press, and TAO has not had the same kind of buzz as like Hyperliquid, which VCs in Wall Street love because they understand it. It's a DeFi exchange with 50x leverage. So huge numbers of people go broke using Hyperliquid, but Wall Street loves it. That's how they make their money. So, but TAO is just different for them. Like, I don't understand this. That's the reaction from Wall Street is usually, I like Hyperliquid over TAO, or I like
Bitcoin had the same problem. Bitcoin had the same marketing, branding, communication, explanation problem as Bittensor has today.
I mean, this is exactly why. Oh, sorry to interrupt, but this is exactly why you and I we were discussing this.
This is why we're doing it.
Yeah, we're doing TAO Pod. I'm doing the TAO Daily. You're doing amazing tweets every day, and we're trying to selfishly, we want people to be aware of TAO, but also we love it, and there's so much to talk about. It is a digital representation of the free market that it's never existed before. This is entrepreneurship 2.0 right in Bittensor.
I'm very proud to be a shill of something I have a lot of exposure to, and I recommend it highly, and I think everyone should try it out. Skin in the Game. Okay, Nicholas Nassim Taleb has written a series of books called Inserto. They're right behind me, actually, right here in my bookshelf behind me in my office. I recommend people read those books, by the way. Nicholas Nassim Taleb is a brilliant man, former Wall Street trader and hedge fund manager. And he has this phrase, skin in the game. Now, what is skin in the game? It's when you actually have an incentive to add and compound value for something that you care about, but you actually own a part of. You're participating. You experience the upside when that thing does well, right? And I would actually say it is as important to have skin in the game of something that you're heavily advocating for. It adds your credibility. It actually causes people to take you more seriously, because why would you be advocating for something that you personally don't have skin? If you really believed in something, you would own some of it, of course. Now, there's an additional thing that we do here, James, that I think is as valuable, which is to really master something, you have to teach it. You have to educate people about it.
I agree with that.
You have to actually educate. And it forces you. For me, I've actually benefited from this, even though I would consider myself pretty expert level at Bittensor when we sort of met and started the podcast. I have increased my knowledge. I have increased my understanding. I have increased my conviction by virtue of the fact of doing this podcast with you, because we're educating people that listen to the show about how Bittensor works, what's happening, what are the macro conditions, what are the micro things, which subnets are cool. How does this relate to capitalism and venture capital and entrepreneurship and value creation and trading and stocks and all these things? And demystifying the complexity of Bittensor will remain a challenge and a problem for many years to come. I was saying earlier, Bitcoin had this problem very early on. I think Satoshi was interacting with someone in one of the mailing lists saying, if you don't understand it, I don't have time to explain. I'm sorry. And he just apologized. And so Bitcoin really evangelized itself through the data. Like if you look at the hash rate over the last 15 years, it is basically a straight line up and exemplifies the success of the incentive mechanism, the competition that Bitcoin has unlocked and created for people to secure this money database, right? And my tweet yesterday was basically highlighting the fact that Bittensor is a generalization of Bitcoin. It sounds like a fancy word, generalization. No, it basically just takes the same ideas and design of Bitcoin and applies it to capitalism. How does capitalism work? Well, you start a company, you create a great product, you serve your customer, you make your customer really happy, they give you money. If you make them more happy, they give you more money. If you continue making them happy for a long time, they keep giving you money. It's really great. That's what makes the world go round. That's what has caused and driven all of human progress. The biggest force and driver for human progress is capitalism and business. And it directly funds and accelerates science as well. A lot of people think, oh, no, science and it's these other things. No, science would not exist without capitalism. We would not be able to fund and systematically invest in those things. Governments create currencies. Currencies succeed because of capitalism. Subsidies and grants would not be possible without capitalism succeeding in order to allow the currencies to be durable stores of value and representations of value to fund science. Therefore, capitalism is the most fundamental driver for change, period. There are no arguments. There are no arguments against this.
There's great examples too. I mean, obviously, most people or many people know the historical examples, but there's a great way to understand this. So Soviet Russia would have these 5-year plans. When it was the Soviet Union, they would have these 5-year plans, and the Central Committee of the Communist Party would meet, and they would decide, okay, how many apples will Russians eat over the next 5 years? Because that's how many apples we have to either grow or buy from other countries. And the net result of that was starvation, and tens of millions of people died. And meanwhile, New York City, not a single apple tree grows in New York City. None. And nobody at New York City makes a decision, well, we're going to have to buy some apples because there's no apple trees here. Nobody in New York City government makes that decision. And yet, nobody in New York City starves. They all have enough apples because the free market, capitalism, decides how goods flow. And you're right. So, and Bittensor being this, with their incentive mechanism, make this point in your recent tweet, which I'll get to in a second. Bittensor is this perfect digital representation where capitalism can succeed, and the currency aspect is not even the most important part. It's the incentives. So in New York City, a grocery store has an incentive to go call up Oklahoma and say, hey, send some of your apples over here because we need some, and I want a discount. So because they know that their customers are going to need so many apples. And you made a really great point in a recent tweet that what Bittensor did was make 128. There's 128 subnets right now. What Bittensor did was to create 128 Satoshis, and Satoshi is arguably the greatest entrepreneur of all time. I mean, he created 1.7 or 1.8 trillion dollars in value in 15 years, whatever Bitcoin's worth right now, and then he created this phenomenal industry around that. And when you say, "Oh, Bittensor has 128 Satoshis," is because a subnet, the subnet owner, the Satoshi of that subnet, basically stakes TAO. So the more subnets there are, it creates buying pressure for TAO, but they stake TAO, and now they are allowed to change the incentive part of the cryptocurrency called TAO. They can change for their purposes, for their subnet, the incentive mechanism, and that creates their company. Every company is ruled by all the incentive mechanisms. Incentives for shareholders to invest, incentives for employees to work there, incentives for customers to buy it, to buy their products, and on and on. And that's really just the magic of what Jake Steves and Ala, built when they built Bittensor and TAO.
Yeah, it's really important to understand, what does it actually mean that Bittensor took the design of Bitcoin, generalized it, and created something that was disruptive and transformative to capitalism, right? In the same way that Bitcoin is disruptive and transformative to capital. As Michael Saylor says, Bitcoin is digital capital, right? Beautiful way of describing Bitcoin. Bittensor is digital capitalism. What does that mean? It's hard to understand. So let's read this tweet. By the way, it started off a little bit meandery because I was curious. If you mined Bitcoin during the second halving, which by the way, the first halving, which was the 50% reduction in the block reward from 50 BTC, 50 Bitcoin every 10 minutes to 25 Bitcoin every 10 minutes, right? And so let's read the tweet, November 28th, which is in 4 days from now, actually, 2012, till July 9th, 2016, that's the first halving 4-year period. So the second 4 years of Bitcoin's existence. I did the deep AI research thing. I probably spent 20 minutes on this, which is a long time for the AI. And it would have cost, in current dollar terms, $50 million, which really, honestly, is not that much money if you really think about it.
What do you mean by cost?
It would have cost $50 million in hardware and electricity to mine 10% of all the Bitcoin rewards paid out or delivered to miners over that first halving period from November 28th, 2012 until July 9th, 2016. So from block, to be a little bit technical, from block 210,000 to block 420,000, right? Now, over that 4-year period, the hardware and electricity costs, right? Because the hash rate for Bitcoin, I'll scroll down a little bit showing the hash rate here. The hash rate for Bitcoin was so low in that time frame from 2012, end of 2012 to mid 16. it wasn't even showing up on this chart in exahashes. EH to the far right there is exahash. We just passed zettahash. 1,000 exahash is 1 zettahash. So I'll summarize this again. Just to mine 10%, which is 520,000 Bitcoin tokens, right? It would have cost $50 million. Now, if you bought it instead, if you dollar cost average bought it across that same time frame, when the price was, I think, between $200 and $800 or something like that over that period, you would have made 6 to 10 times less money if you mined it. So mining, my hypothesis, what I know is factual. Okay, what I know is factual.
6 times more money.
More money.
Yeah.
What I know is factual is over that first halving 4-year period, what I know is factual is mining Bitcoin was almost an order of magnitude more profitable, almost 10 times more profitable than just buying the same amount. Than buying $50 million of Bitcoin, you would have made, $400 million. Buying 50 million would have generated a great return. Mining Bitcoin, spending the hardware and electricity costs to do that, which we should have a separate report because it shows you like the specific Antminer ASICs that you would have had to buy, and the electricity and the cooling and everything. By the way, it would have been able to fit in one room. Like the size of my office here, maybe 2 of them, you would have been able to fit enough hardware to mine 10% of all of the Bitcoin getting produced in the block reward within that second halving, right?
Well,
within the first halving.
Here's a naive question. Like, why is that? Like, what is that? Because the number of transactions
it's because the hash rate.
Lower?
No. I'll explain. I'll answer your question. It's a great question. The answer is because the hash rate was so low, right? The hash rate is a measure of the computational difficulty of solving the SHA-256 computational puzzle on Bitcoin below a certain difficulty threshold. And that's what secures the Bitcoin network. That is the incentive mechanism on Bitcoin. The computational competition, the puzzle that miners have to solve on Bitcoin is a cryptographic hash. It's a mathematical puzzle. It doesn't do anything for you. It's not useful.
Why did the hash rate get more useful? Why did it get more complicated? Why do we need more higher hash rate now?
It's getting higher in computational complexity and difficulty in proportion to the degree to which the puzzle is harder to solve based on the amount of calculations that are necessary to actually crack and solve the correct size of the cryptographic puzzle, and that secures the Bitcoin network, right? And so it's roughly close to, let's say, some very meaningful fraction of the total market cap of Bitcoin. Just to roughly, without getting too mathematically complex with this, it's roughly comparable to some very meaningful amount. Let's say 10, 20, 30%. It's not 50%. It's much less than that of the market cap of Bitcoin in electricity compute to basically take over the network, to do what's called a Sybil attack. And so I think it might even be around 10%, because Bitcoin's worth 1.7 trillion today at the current drawdown price. For a while, it was 2 trillion plus, 2.5 trillion briefly. And so, let's say 10, if you had 80 billion, right, of compute and electricity, you could theoretically garner enough of the hash rate to potentially delete Bitcoin tokens from the network and rearrange addresses and manipulate the data and basically corrupt the data on the chain. No one's done that because it just doesn't make sense. You wouldn't have anyone go and say, look, we're going to take $50 billion or $100 billion and do this. Risk reward adjusted, it's better to literally take that and buy Bitcoin, because you will make more money over time than you will destroying the network and destroying all that value. The incentive alignment mitigates that risk, okay? Now, I just wanted to point out here, mining Bitcoin at the level of computational difficulty, which was very elevated relative to the first 4 years. By the way, the first 2 years, Bitcoin was launched January 2nd or 3rd of 2009, right after the Great Financial Crisis. There was literally 10 people mining the entire network in 2009. You would have been able to mine 20% of the Bitcoin block reward. It was 50 Bitcoin per day, per every 10-minute block per day, 7,200 per day, 7,200 Bitcoin per day. You would have been able to mine 1,000 Bitcoin per day, 2,000 Bitcoin per day on one workstation.
That's
unbelievable. That's how low the computational difficulty was solving SHA-256 depth at that level of the hash rate in that first year. Okay, so let's read this post a little bit more so we can conceptualize some things. What is Bitcoin doing? Is an incentive mechanism, right, shaped around a perpetually more scarce reward. That's the token Coinbase. It's called Coinbase. It's the 21 million tokens. That's why Coinbase is called Coinbase. Brian Armstrong's obsessed with like the technical inside guts of Bitcoin. Over a computation that requires more hardware and electricity optimization, right? And so it's essentially a commodities market that more and more accurately prices the cost of electricity and the cost of hardware to crack and solve this cryptographic puzzle and earn a block reward. Okay, so let's keep going. However, the proof of work requires, the Bitcoin proof of work, which is a big innovation by Bitcoin, requires a purely puzzle-based and abstract, directly useless, other than its ability to increase entropy. I'm being a little technical here. What is entropy? Entropy is complexity and chaos and uncertainty. As you increase entropy, you reduce the basically ability to manipulate or take over something. Right? As you decrease
like most
entropy,
of my relationships.
Yes. Yeah. You can use all kinds of analogies. And so it's a cryptographic computation. It's not connected to real world utility other than securing the transactions of the Bitcoin ledger itself. What Bittensor does is it generalizes this. It mirrors the same scarce tokenomic game theory, right? We're using John von Neumann style game theory here. 21 million supply cap, 4-year halvings, no corporations or VCs, totally fair launched. And it's launched, by the way, by former Google and Waterloo AI researchers, two geniuses, Ala Shabana and Jake Steves. And then furthermore, Bittensor allows n-dimensional, this is where things get really amazing, as we know. Bittensor allows n-dimensional, which means an infinite number. Right now there's 128. Over time, there's going to be an infinite number. N-dimensional, which means they can be probabilistic, they can be deterministic, they can be anything, like capitalism. Computational puzzles, which are essentially long-running competitions, aka incentive mechanisms, and they can be expressed by anyone, not just one Satoshi, but many people on the planet. And now we enter the subnets of Bittensor. There's 128 today and growing. Shoots, which is permissionless, incentivized scaling of tokens inferenced, right? So if you inference tokens on the Shoots network from Llama, Quen, DeepSeek, Kimi, any of these open models, you are contributing to the success of the Shoots network, and the miners get rewarded as people run and host those models successfully.
So can I just try to I just want to understand that. And
yes.
So basically, Bitcoin had this one incentive mechanism its entire history, and it was just to incentivize people to do this meaningless computation in order to secure the network. But now subnets each one has its own. Everything else is just like Bitcoin, except they get their own incentive mechanism. So Shoot says, okay, our competition is going to be if you can host DeepSeek or Mistral or any of these other open source AI platforms, and our customers will hand you queries. If you can host them and give accurate and fast returns, you win the puzzle for today, and you get our rewards.
You get the block reward. You get some of the block reward. Correct. That is the hash rate, right, of Shoots, which is subnet 64 on Bittensor. By the way, if you look at the hash rate graph that I also highlight in this tweet, what's really incredible is each subnet on Bittensor has a similar graph. Now, this is one of the most mysterious and hard to access charts. We're working on adding this to TAO app. We don't have it yet. We're doing that soon because each subnet has a different computational output, right? And so we need to shape it and render it in a chart that people can easily see like this, like you go on a stock chart, but it's not the stock price. It's not the trading data. It's not the alpha flow emission bullshit. It's the real useful utility output being produced and generated by the miners on the subnet. And
right. Like
it's very similar to Bitcoin.
What they produce, as opposed to Bitcoin, is directly sellable to a customer.
Correct. The output is 100% monetizable. It is real world utility. It is non-financial. It is non-abstract. It is useful work. It is proof of useful work. It is proof of valuable computation. Bitcoin's SHA-256 hash rate is not useful directly. I want to make a point here. It is very useful indirectly. Okay? So why is it very useful indirectly? Because indirectly, people think of the mainstream, 500 million people on the planet who hold Bitcoin or know about Bitcoin at some level. Probably billions of people have heard of Bitcoin at a distance, but let's say 500 million have actually at some point touched it. They don't know anything about the SHA-256 puzzle and hash rate and all that. Oh my God, it's so complex. All this math. Oh no, Bitcoin is money. Bitcoin allows me to send money to my family. Bitcoin allows me to save money so I'm not screwed over by my government massively printing the currency so I can't buy a banana for my child for lunch today because the banana is now $180 denominated and I only have $14. And last week, the price of the banana was $14 and now it's $180. So I can't buy the banana anymore because my government's fucking stupid, right? So people understand it viscerally at that level. They don't understand the complex puzzle. The hash rate secures the network. That is the indirect gift and value of this increasing exponentially hash rate, which is, by the way, truly incredible. If you look at the amount of calculations, we're talking about quadrillions of calculations per second at this point. I think it's actually even more than that to be able to solve the block reward on the Bitcoin network, which is why people invest in data centers that are stuffed with Antminer ASICs to the tune of tens of thousands of them with liquid cooling and all kinds of cutting edge modern engineering design to mine just 2% of the Bitcoin block reward. By the way, what is the Bitcoin block reward today annually? Tens of billions of dollars worth of Bitcoin getting paid out to miners. By the way, just to miners, not to people buying Bitcoin, but to mine the Bitcoin, right? And so it's a very interesting thought experiment to actually look at the periods of time in history when the accumulation of Bitcoin ebbed and flowed in terms of capital efficiency differentials between mining it and people that just were buying it in brute force through pulling together entities and vehicles to just buy a lot of the supply, OTC, secondary, or over exchanges when Bitcoin started to become more liquid and traded, right? I still believe long term, based on this analysis I did in the beginning of this tweet, I still believe it to be the case that it will perpetually be more capital efficient to mine Bitcoin than it will be to brute force mine it over a long enough period of time, given that the incentive mechanism of Bitcoin fundamentally incentivizes hardware engineering optimizations that reduce the cost of solving the SHA-256 cryptographic puzzle and cooling engineering optimizations, basically chip design and all kinds of material science innovations. Like Bitcoin is a bounty on chip design improvement to solve SHA-256. Bittensor is a bounty on any technology improvement. It is deeply profound. We have been underselling Bitcoin Bittensor for the last 12 episodes of this podcast, James. Bittensor generalizes this design across all possible ways of expressing capitalism, which has resulted in, as we discussed earlier, the fundamental cause of all primary human progress in modern civilization over the last 250 years, since the creation of basically what you would consider Western free market democracy, aka the founding of the United States of America, right? And so, hundreds of trillions of dollars or something like that. So I think it's and again, each one of these subnet examples I'm giving here at the bottom of the tweet, they have their own domain-specific, as I call it, hash rate, right? Shoots has that hash rate for inferencing tokens. By the way, they've generated 25 trillion tokens by miners just in the last 8 months. That's incredible. Which is outperforming Anthropic with 1,000 times less capital, with their own hash rate that hill climb software engineering agents, mixed, highly complex SWE-bench competitions. AI researchers will know exactly what I'm talking about when I say SWE-bench. TAO hash, this is very meta. We've actually created an incentive mechanism that rewards people to actually mine Bitcoin, but we give them an extra incentive for doing that, which is the alpha token of subnet 14, which is TAO hash. Training at home. I was thinking of SETI there for a second. Permissionless incentivized scaling of hierarchical reasoning models, which are very compute efficient, parameter efficient LLMs. That is expressed as a domain specific hash rate. Targon, there's a category of compute subnets, GPU hosting subnet. They incent miners to offer up confidential AI compute for running inference, training, fine-tuning workloads. That's a type of hash rate.
And by the way,
Right.
it's not just AI companies. You have Bitcast, which
Yes.
incentivize. They have a puzzle. Who's going to make the best video for this advertising campaign we're doing? And that's the incentive. Or you have Better Therapy. Who's going to be the best AI therapist for this potential patient? And that,
Drug discovery. Nova's doing drug discovery protein prediction for curing diseases and for discovering new types of drugs. We've seen Eli Lilly, and a lot of this is just due to regulation, of course, but Eli Lilly has gone from being, I think, a $20 billion company 5 years ago to $1 trillion company because of obesity epidemic and people, stuffing their face with food constantly because of stress and depression and all kinds of things. And now there's GLP-1s and Ozempic that are extraordinarily expensive drugs, have created $1 trillion company. And that's because of one base human condition, which is not knowing when to stop stuffing your face with food. And it's $1 trillion company. And again, the drug industry, healthcare industry, that's probably a $20 trillion industry or something like that globally. We have a category of subnets on Bittensor that are permissionlessly incentivizing competitions that reward miners, which are people, and they could be AI as well, to identify, synthesize, and deliver new drug discoveries that cure horrible human diseases and mitigate them and deliver all kinds of solutions to that. So, and we haven't even seen the results of that yet because that's a very early category, but it's incredible how general purpose Bittensor is.
Yeah, but I remember, early stage biotech companies are also worth billions once they're on the stock market. I mean,
Correct.
They have zero revenues. They're still going through FDA trials. Maybe they haven't even done their drug discoveries. They just have hired like a great scientist and they're worth billions. Whereas the Nova subnet is, I don't know what it's worth, but it's probably in the single or low double digit millions.
Yes, correct.
And yet they're using like these AI, the people who are mining, they're the best people in the world at doing this. And that's why they're offering their services. They're not offering their services for free. They're mining the Metanova/TAO tokens. The subnet tokens are denominated in TAO. So ultimately you get TAO tokens or you keep them in the subnet tokens. But let me ask you a question, JJ. If you were, say you're a young guy, just out of school, or maybe you didn't even go to college, what would you personally do if you wanted to be a miner on TAO, on Bittensor?
It depends on what you're interested in. What I find really exciting about Bittensor is there's such a broad library and menu of choices. There's such a rainbow of options, right? It's almost like going to the grocery store and thinking about, what kind of chips do you want to eat? You walk down the chip aisle and there's going to be like 50 different brands of potato chips and gluten-free pita chips, and you're going to walk by the Cheetos and you're going to walk by the Frito chips and all kinds of things, right? I think Bittensor is looking kind of similar. It will begin to cater to every possible variety and diversity of preference, taste, style, category, industry, application that you can imagine. And so as a young person, the really important key with all of this choice, you're just like inundated with choice, right? This is just kind of like part of being a human in 2025. You have to discover when you're really young what drives you, what you're interested in, what you're passionate about, what you really want to solve, what animates you, what makes you jump out of bed in the morning. And the main thing that I tell young people, and the attributes that draw me to people that I want to work with and collaborate with and invest in, because I invest in a lot of young people, is what are they freaking obsessed with? What are they just like, they can't stop thinking about it. They don't consider it work. They're just going to do it regardless. And they've lost themselves, and it's just like a constant thing, and they can't stop digging and digging and digging. And it's this like endless, reward and journey for them. And I think if you discover that, that's the first key. You have to find something that you really want to go deep on. And once you've identified that, I think you just start to look at the subnets, look at the top 20 subnets. I think that's where most of the quality subnets are today. And, you're going to see a lot of options. There's a subnet that's rewarding people to generate, 3D assets of different types of things, virtual worlds, world models, right? So generating AI models. This is a huge category, by the way.
So
It's used for video games, but look, the trajectory of video games is on an arc where we will not be able to distinguish between the video game and base reality within probably 5 to 10 years. That's really where I think the trajectory of the video game industry is, by the way. And I've invested in a couple of video game companies. They're actually among our most successful investments we've ever done. The video game industry is the most profitable software category of all the software categories. Okay. There's a company called Valve. Not many people realize this. I think they have 200 employees, and they make about $20 billion a year.
Wow. I didn't realize this.
$20 billion a year. Yes. It's run by a guy named Gabe Newell. Gabe's worth, $10 billion or something. And it's owned, guess what? It's owned 100% by Gabe Newell, or like 80% or something like that. He owns the whole thing, basically. And, the guy's extremely rich, but they are an infrastructure platform for the video gaming industry, right? So you publish the games, you consume them from that. It's this Valve Steam platform. Video games are really huge, but they need the fuel, which is the data and the virtual worlds and the environments that allow the game designers to then tailor the game experiences. So there's a subnet, it's called 404, subnet 17 on Bittensor, where the incentive mechanism rewards miners for producing these virtual worlds. If that excites you as a young person, if you're like really excited about video games, by the way, this is something a lot of young people are excited about. They love playing video games. That's really cool. I've personally never really been a huge video gamer, but I understand like that it's a huge thing. Maybe that attracts you. Maybe that really draws you in and makes you want to mine that subnet.
And so the customers of that are the game designers who need 3D objects?
Yes, it could be studios. It could be game studios that need the 3D assets. It could be movie studios. It could be designers of 3D experiences, virtual experiences. It could be companies that want to create an immersive, virtual world for their employees to sort of navigate and meet each other. All kinds of applications.
So this is interesting. So what does the subnet owner in this case do to incentivize the miners? Does a customer say, "Hey, I need a Death Star, like the Star Wars Death Star"?
Yeah, what the subnet does today, I believe, I'm not super familiar with their incentive mechanism, but they basically create new, more and more complex competitions or puzzles. That's the job of the subnet owner, that basically elicit better quality 3D assets from the miners. Let's say we want a whole library of, 3D assets that are generating models of smartphones of every possible device type. I happen to have a lot of smartphones. Don't judge me. Here's another one.
Why do you have so many smartphones?
That's another smartphone right here.
What the heck?
I have crypto signing ceremonies. So we have like these different devices. Let's say you needed to generate a lot of different 3D assets of these different models of smartphones going back 20 years, right? For, manufacturing purposes. Maybe you're Apple, maybe you're Samsung, maybe you're one of these competitors to these people, and you want to design a better smartphone, but you need a great asset library of training data of all the possible shapes and permutations of every model smartphone from Samsung and Apple and all the other ones going back 15 years. I don't know, that's probably 10,000 different asset objects of different shapes and sizes with different cases on them and stuff. Wow, that would be really valuable training data. Okay. So theoretically, 7at17 could create a competition that lasts, 6 months as part of their multidimensional incentive mechanism that says for miners that deliver these assets to the subnet and gradually show higher quality graphics and assets that adhere to our specifications of shape and quality and resolution and so on, we're going to allocate 20% of our emissions, right, for that specific type of output from the miners. And it'll be distributed granularly across, the top 20 miners that go and compete. That's the job. The job of subnet designers on Bittensor is to shape more precisely the way the incentive rewards certain behavior, right? And yes.
Well, what's good also is you're not limited to your employees, meaning,
correct.
Okay, let's say I start a company to make 3D objects for gaming companies. I'm going to hire 3 to 5 or 10 people, however many people who I think are the best people who applied for the job.
Yes.
Who could create 3D worlds, 3D objects. And the problem with that is, what if they're just not the best 10 people in the world? In fact, what if they suck, but now it costs money? It's like breaking up. Like you have to fire somebody and that costs money.
They're expensive.
You wasted
They're
time.
Expensive.
So what happens with these miners is that, maybe tens of thousands of people are aware of this contest where they could be, and I put contest in quotes, but they could be rewarded some sort of currency or tokens if they create these AI generated 3D models. And those, sometimes the best 10 in the world might change. And so depending on who wins the competition every day, those are the best in the world. You're not limited to a world to just your employees. You're limited to the 10,000 people who might ultimately participate in your contest. And I'll give an example from my own experience. So 20 years ago, I was managing my own hedge fund, and I based it all on software that I wrote to recognize statistical patterns in the stock market. So a simple example, this is a naive example, but I would look for patterns like, if the Nasdaq's down 4 days in a row, what typically happens on the 5th day? And is it statistically significant enough to make a trade on the 5th day? And so that was just me writing the code. But what if I set it up as a subnet? And so now I'm doing the trades and making money, and then I open it up to the best AI stock market predictors in the world. Yep. And instead of me trying to write 100% of the software, I've got the best AI stock market predictors writing software for me, and they're incentivized to do it because I'm paying out in tokens, and then in profits I generate or fees I generate, I'm going to buy back the subnet tokens, so that increases their incentive to get and hold those subnet tokens. I would have a much better hedge fund because I would be using the models of all the best AI people in the world instead of just relying on my own.
Yes, I've historically been very skeptical of subnets like this. There are quite a few actually, and some of them have shown some pretty impressive progress, and some of them have been working. I'll explain if you like why I'm skeptical of these. The reason is, if you create an effective incentive mechanism that actually elicits, miners to create, trading strategy automations, algorithms, what have you, that actually work, right? That generate profits asymmetrically, consistently. Why would you give that away to a subnet in exchange for some fraction of an alpha token that's mispriced? You would take the trading strategy and execute it on real money in your account, and not actually give up the asymmetry. I can see how it could work, but what's your view?
So first off, I agree. I am also very skeptical of the prediction subnets, but slightly different reasons. But if I'm a miner of that, maybe I'm young, I don't have money, I can't, and maybe I'm just a tech person, I don't have the market. 80% of the skill of running a hedge fund is raising money and having the personality and the hustle to raise money. So, and this being a VC, that's a hard work to raise money.
But you just do it on a smaller amount of money.
Yes. And then, but here's the other thing though, is that, and this is particularly if the subnet is relying on these predictions to make money, is that ultimately every statistical advantage you can get is arbitraged away. Enough people figure out what these signals are and they start doing it themselves.
Yes.
And it's hard to make money. Now, the weather subnet, the weather prediction subnet might be different because they're not just betting on the weather, or you know, maybe electric companies are, or utility companies, but there's not as much arbitrage. So yeah, I agree. Basically, with most prediction markets,
I wasn't commenting
until it doesn't.
Totally. I wasn't actually commenting on the prediction category in general. I was just talking about like algorithmic or monetary economic trading competitions specifically, which are a type of prediction. I think if you're predicting the weather, well, I mean, if you're generating higher quality weather predictions than the weather company or these other types of proprietary APIs, there's a huge market for very precise geolocated weather predictions that you can then take the data generated by the subnet and monetize it and build products around it in all kinds of ways. That's super valuable. You can build potentially prediction markets. I've actually changed my points of view a little bit on prediction markets over the last year because, you know, we have these like Polymarket and Kalshi, these big prediction markets where, you know, people are actually creating very liquid and deep trading pools based on these very easy to verify outcomes, right? So like if you know, for example, rate cuts, right? Like how many rate cuts are there going to be in the next 6 months and how deep are they going to be, right? And then you create a probability distribution of those things. Like, you know, you could definitely see a pretty significant prediction market emerge based on that, because we actually know as well, using sort of like macro and micro monetary theories, that rate adjustments actually really heavily affect the movement of the stock market and the cost of capital and lots of these things. And so I think prediction markets in a very abstract way, like, you know, something more stupid like, is James going to wear funny glasses in the next Tap Pod podcast, right? You know, and if that happens, you can get very granular with the prediction market. You can also get like much more about like, what, you know, next major election cycle, is someone going to get assassinated, you know, in this period, right? Like whatever. And you could get more intense with it. So prediction markets abstractly in terms of like the real world, what's happening. You know, I actually thought that they were really useless and just crazy gambling kind of experiments. But now I think that they have some utility.
You know, I kind of like them for the gambling aspect. There's this gaming component, but you know, the stock market is basically gambling.
True.
Most people have no idea what the companies do. They're looking at meaningless things like charts and so on. So, but you know, the other thing is, I like what you said though. What is, if someone wants to be a miner or a subnet owner, what are they passionate about? What are they obsessed with?
Yeah.
And someone might say, oh, well, I'm not obsessed with AI software or AI programming, so maybe this is not for me. But let's just take a random thing. Let's say you're obsessed with politics. Like I know in the last election cycle, half of Twitter was obsessed with politics, and that's all people were arguing about all day long. Let's say you're obsessed with politics. You could do something completely unrelated to anything we've spoken about so far. So I could create a subnet that's basically a political newsletter. And so the miner could contribute articles about politics, and then I could charge advertising on my platform, on my political newsletter, on my website. I'll charge advertising, and then whoever generates the most advertising dollars gets rewarded the most, wins the miner rewards, gets rewarded the most tokens for the day. And then I can use the revenues I generated from advertising to buy back the tokens, to keep increasing the value of the SOPNA token, so the incentives go up, so more political writers are incentivized to contribute articles, and so on. So I could either be obsessed with politics, I could be one or the other. Oh,
I think
definitely could work.
That could be pretty huge. And then you could have a subnet that actually determines the outcome of some election cycle, and then take the gains from that and funnel it into that political campaign. And
that's a great idea.
Maybe even transfer the treasury if the candidate gets elected to boost the agenda on particular items that were promised during the election period, right? You could get very exotic with something like that for sure.
Yeah. So you know, I could have my incentive mechanism have nothing to do with technology at all, just the quality and the engagement of these articles. And you know, the other thing about incentive mechanisms is that you could change your incentive mechanism all the time. So take Ridges as an example. Their incentive mechanisms for a long time were about beating the benchmark tests for AI coding. And but when they launch a commercial product, okay, now I don't know what they did. I'm just making this up, but they could change their incentive mechanism to say, hey, I need a good UI, a good user interface for today my incentive mechanism is just going to be design me a good user interface
Yep.
for the product. And, miners could be completely different that day. And now, from what I understand, the incentive mechanism is more related to the real world use cases that the product is now seeing. So he's changed the
Yep.
incentive mechanisms to deal with real world problems instead of the benchmark problems. How's
True.
his rollout of the commercial product going? I mean, it was just 2 weeks ago, so I don't know.
I think it's going. I think it's going well. I think they've been kind of hand inviting people and getting early feedback. But from what I'm aware of, it's been very widely positively received by the people that have access to it. And I'm waiting on when they actually release it publicly, and then we can see kind of like how it actually compares to something like Cursor's latest model, Cloud Code, and how they monetize it. I think that'll be really big.
I mean, we don't
a big
really
bet.
give investment advice on this TAO pod, but Ridges has their price has fallen a little bit today. It's up 14% because Shaquille gave this great talk yesterday. But Ridges is one that really, to me personally, seems extremely undervalued.
Yeah.
So
No, I totally agree. It's been volatile, but again, look at the highest performing assets. It's pretty clear that they're all very volatile. I think it went up 10% yesterday. So it's very volatile. It's still in the top 3, top 4 subnets. So we're gonna continue to see a lot of changes in the top 10 for sure.
if you're so 2 questions. If you're a miner, how much would you try to make per day? Let's say you were mining on a top 20, top 30 subnet. On average, what do you think a miner can make per day if they're good?
Well, we can look at the data. So this is actually pretty easy to assess. So if you want to mine, let's say what you really want to look at is the amount of emission getting paid out. So let's sort by emission, right? So this is the emission column. I'll move it over here to the left, so we can get a better sense of the percentage of emission. So emission percentage is the percentage of TAO emitted to that subnet's liquidity pool per block. You could say per day within the first 4 years, which we're about to end in 30 days now. By the way, in less than 30 days, I think it's
2 weeks,
actually
2.5 weeks.
18. Yeah, pretty crazy. 18 days and have the block reward go down from 1 TAO to 0.5 TAO. And so that's 7,200 TAO per day. Currently, it's going to be half of that. But let's just back to the list and answer your question. If I wanted to make $10,000 per day, all I need to be doing is looking at the price of TAO, which is $295. Let's just say $300 in round up terms. I need to be earning something in the neighborhood of let's say 30 TAO per day, and again denominated in alpha, right? And so you can see if the top, let's say the top 10 subnets are making more than % emission, right? Or let's say 1, 2, 3, 4, 5, 6, 7. The top 8 subnets, roughly the top 10 subnets are making about 2% emission. So 2% emission per day is 7,200 TAO per day. 2% of that
140
is 144 TAO per day. 144, and then they paid 40% of that, but let's say it's about 50% of that, which by the way, it should be higher. It should be 9%. And that's kind of the gradual process of Bittensor shaping these incentive mechanisms better. But let's say 72 TAO per day would be the block reward, just 2%. So all you need to do is get 1% of just 1% of the TAO block reward per day as a miner, and the top 10 subnets are already over 2%. That's over 40% of the total emission, right? In just the top 10. So you really only need to get like 20% of potentially some combination of Liam, Shoots, Targa, Ridges, Templar. So you could do distributed trading is Templar. Ridges is software engineering. PTN is actually these trading algorithms. Targon is GPU compute. Affine is reinforcement learning. Liam is also GPU compute. And Shoots is kind of these hosting open models. That's kind of one of the top subnets for a while now. So you really don't even need to be probably a top 20 miner to be making $1,000 a day. And $10,000 a day in TAO, is $300,000 per month. That's $3.6 million a year. That's pretty phenomenal. I would actually estimate there's probably around 100 unique miners making more than $1 million a year on Bittensor, and they could be working nights and weekends. And by the way, I would actually furthermore estimate the vast majority of those people are not mining full-time on Bittensor. They're mining part-time. They're doing this like nights and weekends. They consider it kind of a hobby. They might be selling down some of the tokens to pay for the costs of the commodity. So if they have to like get GPU compute, if they have to generate training runs, if they have to, host models and pay for some compute for that. But I would say, you could just look at the top 10 or so subnets. And also, you could actually also ask Savant, you could say, help me figure out how to select which combination of subnets to mine just 2% of the total TAO emission. Actually, just 1%. We just want to get 1%. Because that would be like $2 million, $3 million a year net, with some mix of the top 10 subnets. Which ones? That's a pretty complex query, but I'm very proud of how sophisticated we've gotten Savant to aggregate lots of data.
Are you using one of the subnets to generate your answers?
No. We have a combination of models that look at a variety of data. Wow, this is pretty great. Look at this. This is a short, concise, and nice and sweet answer. Savant is recommending that we do Shoots and Synth. Shoots, Ridges. It's formatting this improperly, so we have to fix the way it renders. But Shoots, Ridges, Liam, Quantum, and Synth. So if they said if you split your hash power, this is very interesting. Savant's using this hash power terminology. You'll command more than 21% of the subnet's combined emission, which is 1% of the whole network. Wow. Any other mix sums to this. So it's basically giving us some recommendations on which subnets to look at. So that's pretty cool. Savant's gotten a lot better. But I would just really recommend people look at the subnets directly themselves. Here's the Ridges page. So this is the Ridges subnet. So if you want to trade it or swap, you connect a wallet. You can go in and see the chart history. We have the trading view chart. All this is okay. This is kind of the boring stuff for actually trading the token. But if you scroll down, a lot of people don't realize we have this much information on TAO app. We have a huge amount of information on each subnet. So you can see Ridges subnet 62 is an AI software engineering agents platform. We give you an example of what it does, what problem it's solving for, what is the incentive mechanism, how does it work, right? We also, if you want to understand abstractly how incentive mechanisms work, we point you to the docs, and you can see the performance, the benchmark performance, right? So that hash rate graph I was showing you earlier for Bitcoin, if you click view SweBench performance, you can see the incentive mechanism progress of the Ridges incentive mechanism, right? And it's on their website, so that's pretty cool. So, okay, so then let's go back to the Ridges page on TAO app. We have a lot more information here. We can also see the social information of this subnet. So social is, we're looking at Discord, Twitter, all kinds of information on community sentiment, engagement.
Wow,
and
that's pretty cool.
You can see a lot of information on that without even need to go into those pages. You can see the validator breakdown, how people are validating on the subnet. You can see the metagraph. We have all kinds of very rich parameters here. Hyperparameters. You can see, is it active? Does it have rate limits? How many blocks per registration are allowed? Is commit reveal enabled? All kinds of things. And then you can see liquidity. Liquidity positions are actually also rendered in TAO app, which is a new thing we added. So that actually shows how people have been adding to the liquidity pools relative to tau and alpha in the pools. This is kind of a more technical feature. You can see holders. How many people hold the token? Wow, this is actually pretty incredible. There's almost 5,000 unique holders of the Ridges Alpha token. That's really incredible. And you can see the largest holder. There's someone who has $2 million worth of the Ridges Alpha. And you can see the realized P&L, the unrealized P&L, net volume. Right? We have a huge amount of information. All this is free, by the way. We don't charge for any of this. You can see the latest transactions in the owner cold key and the history on that. And of course, you can see volume data on the Alpha token.
That's amazing.
So, but the thing that I would recommend people to do most is go to the website. Go to the Ridges website and read about what they're doing directly on the Ridges site. You can get all the latest information about how their incentive mechanism works, where they're kind of going in terms of their roadmap, and you can go onto their Twitter page. Each one of these subnets, again, is kind of like you said, it's kind of like a startup. It's a company or a group, a decentralized cooperative of people that are continuously improving the outputs on that kind of like permissionless, incentivized network. And there's constant updates. And for people to learn about it, they can just go directly there.
And by the way, the last thing you just showed on TAO.app, I saw a number. What's the size of their prize pool per day? And it was $65,000 for Ridges.
$65,000. Cool. So you really only need to be earning 10, 15%.
To make $1 million a year.
To make $1 million a year, or more than $1 million a year. That's just, which is really amazing. I think top OpenAI, top Anthropic engineers barely make that much.
I do think. Oh, which reminds me. So I was talking to somebody about centralized AI versus decentralized AI, and he was telling me now at Facebook or Google, they're offering up to $1 billion compensation packages for AI programmers. And his feeling was it's hard for decentralized AI to really compete with that, at least right now, because I don't
believe those reports. Personally, I don't believe those reports. I think that there's been a very small handful of legitimate what are called acqui-hires by people who previously had successful companies or previously worked at Meta, Google, one of these places for 10 years, 15 years. They were known to be a very critical MVP, unique person. They worked directly with Zuckerberg on some stuff or something like that. And he's like, if this person comes back, we're going to give them $1 billion of stock and, lock it up for a couple of years and have some vesting associated. I think there have been some cases like that. That is not a mainstream type of package they're offering to people. I think what I would probably say is a more generalized package for the top 1% of these types of AI researchers, depending on a lot of factors, would be, I don't know, maybe 5 to 10 million a year kind of thing.
For the top.
For the top people. And then again, that doesn't really look at founders of companies. So, like if you're a founder of a startup that's like $1 billion company, you might get poached or offered to get some package for $50 million or $100 million or something like that. But it's like dependent on all kinds of things, and it's locked up and you have to stay there for 2 years or 3 years. And it's not like they're giving you that cash up front.
Right.
Might give you some moderate amount of it. And again, you're signing your life away. You're a cog in the wheel in a 1,000-person organization, and you're enriching one of the existing incumbents and adding another 5 billion to their market cap or 10 billion to their market cap, and they're going to give you 2% of that. Right. And so versus if you contribute to Ridges, you can earn 10, 20, 30% of their entire network emission, which, as we discussed earlier, is mispriced massively based on the competitive capital efficiency outputs of what the subnet's delivering. When you compare that to what Anthropic has in the market in terms of the benchmarks and the performance of the models. So
it still makes me think, like what we spoke about last week, we've got to start, or someone should start TAO University, because rather than send, a kid to some crappy
it's all coming together,
school.
James.
Yeah.
It's all coming together. None of this stuff existed. The stuff I just showed you on TAO app, it's still kind of janky, but there's a huge amount of data on there, and it's actually very featureful and very rich. None of that existed 6 months ago. We just built TAO app. We built it in February. By the way, Latent Holdings turns 1 this week on Wednesday. It's our 1-year anniversary.
Congratulations.
The amount of things I'm going to spend probably half of the day tomorrow just writing up a long post on all of the stuff that we have shipped in the last 12 months as a small team of a dozen people. It is an insanely long list. And we're getting.
But what we really were discussing this entire episode is the path to mastery, because if you're going to be the best in the world at the product you produce, you've got to, again, build the right incentive mechanisms, 100%. Have the right rewards. You have to be well capitalized. You have to have the infrastructure of so there's companies building infrastructure around this, like Leighton Holdings, for instance, building TAO app. And, and that's why there's such a varied skill set. But along the way, you'll become master of either, whether it's AI programming or building a company or marketing or, building these incentive mechanisms. And it reminds me of something you said earlier in the episode, which is that, if you want to be a master of something, you've got to teach it. And again, I think part of my incentive, at least for doing TAO Pod and TAO Daily, is this is how I'm learning deeper and deeper. Even though I'm a huge investor in TAO, this is how I'm learning deeper and deeper all the, amazing philosophical and technical complexity of TAO. But it reminds me, I was having a conversation with, of all people, Frank Shamrock. And I don't know if you know who he is. Throughout the 90s, he was like the ultimate fighting champion, a mixed martial arts champion.
Oh, wow.
So he constantly has to learn, or when he was competing, he constantly has to learn new martial arts, because it was mixed martial arts. So it was people from all disciplines were fighting. And so you kind of have to master all these mixed martial arts very quickly, or you won't be the champion. You won't be the best in the world. So I asked him, how do you learn something very fast? And he said something related to what you said, which is I stole this, exactly what he said word for word in my last book, Skip the Line. But he said he had a method he called plus minus equals. So you find your minus, someone who you're better than, who you can beat up. You find your equals, or no, basically the minus is someone you could teach. So is what he was implying. So you find your minus, people you can teach. Then you find your equals, which is people you train with. So you're about the same level and you're competing against each other so you could grow together. And then you find your plus, someone to teach you. And most people only think of the plus. I need to find a good teacher. But you have to have people to teach also, to really show that you've cemented the understanding. And you have to have the equals so you could benchmark yourself again, as you improve. So the plus minus equals technique is, I always thought, a good technique
really
towards
smart.
mastery. Yeah.
That's really smart. I think that there's truth in all three of those with many people that I know. Like, I would actually consider you plus in many things that I don't know, and I learned so much from you. We're probably equals in some areas. And then, maybe you're less good at some things, I'm less good at some things. And then there's this interesting equilibrium.
You've been teaching me about TAO every one of these episodes. So, I'm grateful. That's what I'm grateful for this Thanksgiving was you were the first person in the TAO ecosystem that I met, actually. Because I had been writing about TAO for years on my newsletter. I started recommending it in 2023, but I didn't meet anybody from the ecosystem until I went to Proof of Talk just this past June.
By the way, they're doing it again, so let's go meet up in Paris again in April.
Oh yeah, I spoke to them. I'm definitely going.
I'm going. And then as well.
I think they're doing a conference in Dubai also, which I want to go to.
Yeah, so, it should be fun. Well, happy Thanksgiving, James. This was fun.
Our dozenth episode.
Yeah, dozenth episode. I think we've been pretty consistent. We started this 4 or 5 months ago. It's been a couple periods where we've been choppy, but I think doing this every week has been it's been really great. And it's a very exciting time for Bittensor. It's
so valuable to me, and for anyone listening, please let us know what you learned this episode, or if you just like it. So let us know on Twitter. And JJ, I'll see you next week.
Sounds good. See you next time, folks.